This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
Welcome to episode 239. Another week, Ben.
Another week.
The weeks keep on coming. Anyways, quick overview of today's episode. We discuss another fundamental topic to financial decision-making, which is financial math. And I do indulge myself in your feature this week, so I hope people are patient with some of my stories, but it was a pretty important time in my life that links directly with your topics.
I think people will love it. What are you talking about?
I don't know.
It's like when Robert Merton, when we had him on the podcast, he kept apologizing for giving us these great answers to questions. He's like, "Oh, I'm sorry, I'm going on." I'm like, "But no, please okay. Go on."
Any comparison between me and a Nobel laureate, I will accept. We also take the chance to review in 60 seconds the past episode we had with Dr. David Blitzer in episode 54. He was the chairman of the S&P Dow Jones Index Committee. Super cool
episode. Yeah.
And we also review the book How to Live on 24 Hours a Day by Arnold Bennett. Really cool little book. So our next section, we have notes on it, but we're frankly not really certain what to call it. It's a follow-up to our conversation 2 weeks ago where we talked about how we're here to help more Canadians with their wealth management questions. And we had a bunch of people reach out, so we thought we'd do it again, quite frankly. We're pretty proud of our offering. We believe we have an incredible team that can offer incredible help to people.
Yeah, you mentioned we don't know what to call it. We label all of the sections for ourselves,
right.
And this one we weren't sure what to label it. But we've realized that we talked about this last time. We don't do enough to market ourselves, and so we want to be more deliberate about talking about the fact that PWL is a firm that we work for that has a good offering that a lot of people could use. Anyway, our team, which is a great group of people, they all listen to the podcast. We give advice that's in line with the podcast. So for people that are listening, even if you yourself are a finance nerd or geek, whatever you want to call it, which realistically many people listening are, what we noticed last time we mentioned PWL on the podcast is that quite a few of the people that got in touch were not getting in touch for themselves. They were getting in touch because they have a family member or someone that's close to them that could use our advice and service, even if they as an individual can't. Anyway, if you're in Canada and think that yourself or a family member could benefit from PWL's service and advice, please don't hesitate to get in touch with us. pwlcapital.com. There's a web form or info@rationalreminder.ca.
Exactly. And one of the team will get right back to you. All right. Ready to go to the episode, Ben?
Let's go. Welcome to episode 239 of the Rational Reminder Podcast.
All right, so for the first topic, it's on financial math, which I think is such an awesome topic. And I must say, as I read your notes, which as people know I don't usually do because I try to listen as a listener, but the subjects you cover go right back to a time in my life, back around 1973. I'd be 7 years old when a lot of these concepts came together vividly, and I think about it often. So back then I started earning income. Yes, at 7 years old, I started a business, selling worms, but still it was a business. Saving money, learning about compounding and consumption. We got a new mall in our city. I grew up in Lennoxville, Quebec, so we got a new mall in Sherbrooke, which was right next door. So all this kind of happened at this time, so I'm going to relate some stories from that time to your discussion. So that's my preamble to you talking about financial math.
All right. So are you ready to jump into it?
Fire away.
Okay. So we got to start with the time value of money, which is fundamental to all of finance and personal finance. When you invest money, you expect to earn a rate of return. And when you borrow money, you expect to pay a rate of interest. When you leave money under a mattress, you expect to lose purchasing power to inflation. The result of all of those realities is that the value of money changes over time. So that means that we can't compare dollars that you expect to receive in the future to dollars that you have today, because they exist at different points in time, and time affects the value of money. When money moves forward through time, it's called compounding. That's a term that many people will have heard of. And when it moves backward in time, it's called discounting. And discounting, well, both compounding and discounting are fundamental and very important concepts. All time value of money calculations involve either compounding or discounting. So that's moving amounts either forward or backward in time. Money's like a time machine. It moves economic value through time. Mathematically, the way that mechanism works is what we're going to talk about. Now, thinking through this type of math, and we'll talk about the actual functions, the mathematical functions in a minute, but thinking through this type of math is not intuitive because of compound interest, which is an exponential function. The idea is that when you earn a return on an investment in period 1, in period 2, you're earning a return both on your investment and on the interest or return that you earned in the prior period. So over time, that effect compounds, which is why it's called that. And you get an exponential rather than a linear rate of change over time. Compounding goes both ways. It increases the value of an investment at an exponential rate, but it also increases the cost of a loan at an exponential rate over time. Now, again, to reiterate, this is all important because comparing alternatives in financial decision-making almost always involves time. Almost always.
Mm-hmm. So fascinating. And the example I have, and it is so vivid. So I applied at age 7 to get a paper route. Lennoxville, Quebec, the big paper was the Montreal Gazette, and I applied and waited. Finally got granted a route. I can remember the day. It was snowing out, much like it is here today. Probably this time of year, I was going up a steep part of Clough Street in Lennoxville. It is that vivid. I remember exactly where I was, thinking about compound interest. So I started to save money from the paper route and thought, if I had $100 and it grows at 10%, which back then that's what savings bonds were paying. So $100 becomes 110. 110 becomes like 121, right, in 2 years. 121 becomes 133. I remember doing the math and trying to remember to keep going. Like I was 7, right? I was like blown away that after 7 years at 10%, like it doubles. And I remember my head just exploding at this realization that you're working to save, you're saving to earn a bit, and at some point, like your savings kind of keep going on their own. The compounding, like Albert Einstein said, it's just like the eighth wonder of the world. It just, to a 7-year-old, this was like so mesmerizing to me. So ended up saving the money, going down to the bank because there's nothing digital, of course. You go to the Little Royal Bank branch and you go make your deposit. You get your deposit slip. You fill in your deposit slip and you wait in line to put your deposit slip and a little bit of money in the bank. Then it was savings bond, that little table tent, sitting there for savings bonds. So I bought a savings bond. And then I remember the teller asking me, do you want compound or annual pay? Like you just think about that for a 7-year-old to think about this. Like, okay, just think that through. Compound, I get the money every year, but if I compound it, as opposed to annual pay. So you put the order in, you fill in the paper, you get back your whatever, $100 bond, whatever it was. And I took, of course, the 5-year compounding, right? Liquid at any time, liquid at month end, got my safety deposit box, put my little bond in the safety deposit box. It's incredible to think about the power of compounding at such an age and the incredible difference of interest rates between then and now.
Less incredible now than a year ago, though, the difference in interest rates.
For sure. Oh, there's so many lessons learned in this past year as well. But carry on.
Yep. Maybe not real interest rates, nominal interest rates.
Nominal interest rates.
Okay, so to come back to the concept of discounting, just to think about the time value of money and why this all matters for financial decision making, take a simple example of the decision to accept a payment of $10,000 today or accept $1,100 each year for 10 years. So in one case, you're getting $10,000 up front. In the other case, you're getting $1,100 per year for 10 years. So in total, not accounting for the time value of money, you're getting more money in the second option over the full course of 10 years. So which one do you choose? To compare them, we have to bring their values to a common time period. So if we want to compare them in terms of dollars today, we have to bring them back to the present value. So in the example, $10,000 is $10,000 because it's being offered to you today. Its present value is $10,000. For the $1,100 per year for 10 years, you're getting payments up to 10 years in the future. So money in the future is worth less to you today because the sooner you have money, the sooner you can use it to earn a positive rate of return by either investing or paying down debt. So to account for that opportunity cost, the math works like this. It's the payment received n periods from now is worth the dollar amount of the future payment divided by 1 plus the rate of return that you would otherwise earn each period on those dollars to the power of n. And we'll put in the YouTube video, we'll put a picture of that equation so that you don't have to imagine it.
Right.
So to find the present value of $1,100 annual payments out 10 years, we would manually do this for each future cash flow, put them in present value terms, and then add them up. More easily, we can use a financial calculator or an Excel spreadsheet. And if we just use, and I'm going to use a 5% discount rate or rate of return, but that question is really important. What discount rate should you use? I remember when I was doing my MBA, I did my whole engineering degree without not a lot of finance education. Like there was maybe a little bit of business stuff in engineering, but not a ton. But I remember when I started doing my MBA with a finance concentration, we were talking through something like this. I don't know what it was specifically, but we were talking through something like this. And one of the students in the class asked, well, how do we know what discount rate to use? And the professor just laughed. He said, yeah, exactly. You don't know. You don't know what discount rate to use. But that doesn't matter. It can still be informative for decisions because you can look at, well, what if the discount rate was this? Or if I assume the discount rate is this, then what decision would I make in that case? Anyway, so with a 5% discount rate or rate of return in this example, the present value of $1,100 per year for 10 years is only $8,919. So in that case, you would take the $10,000 today. But what if you had a different discount rate? So I solved it for at what point are they equal, ignoring other stuff like flexibility, I guess. But at a 2.18% discount rate, those future payments are equal to $10,000 today. So in that case, you'd be at least mathematically indifferent between the two options.
What strikes me about this example, and it's so important, is there's information in that number, right? The difference between the 89.19 and the 10,000. There's information there. It's telling you the discount rate or the expected return rate, right? So
Yep.
if it's got a higher interest rate, is it riskier? Whatever that investment might be, like use that as information. It's such a fundamental concept to investing.
Yep. Yeah, the financial math can go in all different, just like any other type of mathematics. You can look at situations from so many different angles using this type of math. Now the exact same type of math, the exact same thing can be used to do things like compare pension start dates. If I start my pension at this age versus this age,
Good point.
you'll have different cash flows, but you'll have fewer periods because if you're starting later, your life expectancy relative to the later start date is going to be shorter. But you can look at what is the difference in present value between those two situations. You can also look at what is the difference in the implied return between those two situations. Another one that's pretty interesting is you can calculate the implied financing rate on monthly versus annual payment options. So if you have the option to pay your insurance premium once per year or monthly, and they're different total payment amounts, you can calculate what your implied financing rate is by paying monthly. It's like you're effectively borrowing. In some cases, maybe it's like you're effectively borrowing at a credit card-like interest rate.
It's funny. My son James got an offer to switch his car. Did I tell you the story?
Nope.
He got this automated email from the local dealership, and they said, switch your car. We'll give you this newer model. And the payment's only $3-something every 2 weeks for 7 years to own it. So he did the implied math on it. It was way above what like typical car rates are right now.
Yep. I remember doing this years ago for cell phone financing. Apparently it's gotten better now, but I remember they offered you could pay cash for the phone or you could finance it through your plan. And I did the same thing. I went and calculated what the implied financing rate was, and it was like 20% or something like that.
So I just did mine. It was at 0.
Yeah.
You
Apparently
put an amount
they've
down,
changed this.
I guess there's so much margin in the phone that probably is why it was 0, but it was 0.
Yeah, I asked, where did I go? The Apple store maybe 6 months ago. And I told them like, well, I don't want to do it this way because the implied financing rate is high. And the guy said that, no, that's changed. So apparently that's.
And in fact, in my case, they said you have to finance it because my carrier is giving, I think, a $20 monthly credit if you finance it.
Interesting.
I guess that's to keep you locked into their contract. I don't know.
Yep. Anyway, so the point is,
we digress.
Making any financial decision, like when we were just talking about random stuff like cell phones, making all these financial decisions, they almost always involve money. They almost always involve time. And to compare alternatives, we have to be able to bring things back to a common time period, which is what financial math lets us do. The other place where discounting future cash flows is extremely important is when we start talking about stocks and bonds. So we covered that in episode 231, but it's the exact same concept. Like the $1,100 per year for 10 years, those are future cash flows. We're assigning a discount rate to decide what they're worth today. A stock is the exact same thing. The future cash flows are unknown. Or less known than my example, but we can still use the information and prices to look at what the discount rate, or at least differences in discount rates between stocks. So same general concept.
And look at bonds this past year. Interest rates went up, bond values go down. That's why.
Right.
And a lot of people aren't aware of that inverse relationship.
Yeah. So financial assets are streams of future cash flows. Stocks and bonds represent streams of future cash flows, and they're bought and sold based on their present values at any point in time. So like you said, Cameron, discount rate changes, you would expect asset prices to change. Okay, so that was discounting. Compounding is discounting tells us about the present value of future cash flows. Compounding tells us about the future value of money borrowed or invested today. So to find the future value of an investment n periods in the future, we take its present value and we multiply it this time by 1 plus the rate of return or the discount rate to the power of n. And again, we'll put a picture in the YouTube video so you can see it. Now, importantly, and it's clear if you're looking at the images, you can see that these are exponential functions. And we're going to get into detail about why that's hard to think about, but that's just a very important point. If you take $10,000 invested today with a 5% annual rate of return, the numbers aren't that dramatic. I should have used a higher rate of return, but anyway, $10,000 invested at a 5% rate of return is worth $16,289 in 10 years, $26,533 in 20 years, and $43,219 in 30 years. So that's time having an exponential effect. But then also if we substitute in a 7% rate of return to that previous 30-year example, instead of 5%, we're at 7%. Instead of 43,219 at a 5% return over 30 years, at 7%, the ending value is, or the future value is 76,123. Relatively small increase in the annual return, relatively large difference in ending outcome.
And the more time, the bigger the difference.
Correct. So the Warren Buffett is a great example of this, and these numbers are just crazy. He's had high returns. So Berkshire Hathaway has beaten the U.S. stock market by a pretty wide margin over its full life. Buffett is 92 years old today, and he's got a net worth around $110 billion. But the crazy thing about Buffett's wealth is that about 97% of it was gained after his age 59. 97% of his wealth was gained after his age 59. He was still a billionaire at age 59. He's worth about $3.8 billion at that time, from what I could find online. But the effect of the exponential function of compounding has been just dramatic on his wealth. So $3.8 billion at age 59, $110 billion now, 97% of that gained after age 59. Now, again, the same type of math can be used to answer complex questions. Like we gave some examples earlier. Other ones that are interesting in this case might be things like whether you should contribute to your RRSP, your tax-deferred savings account, or your TFSA, your tax-exempt savings account, whether you should invest or pay down mortgage debt, other interesting applications. And again, this is all relevant and important because we can only compare dollar amounts at a common point in time. So anytime that we're making a financial decision, we have to think about some consistent time period in order to compare alternatives.
Yeah, and Buffett is such a great example. I mean, he often talks about the power of compounding progress and how much the world has improved over his lifetime. And you look at the quality of life that, was around when he was born compared to what we have today. Like you and I have the same cell phones, basically the same water, same access to books and movies as the billionaires do. But all of this is much better than the billionaires 100 years ago. So it's an amazing, amazing story. So speaking of stories, I wanted to share this one. I started my first little business when I was 7 years old, so 1973. So I'm holding up a sign. You can see it there. Can't see the English part. So put this sign in our front yard that said worms vert. So vert is worms in French. I didn't know that either. So I started selling worms to my father's friends who were fishing regularly at their camps and whatnot. So end up picking worms, and my parents said, you want to sell more worms, they didn't say scale, but you have to build a bigger business. So I went out and invested, I remember distinctly, $70 to buy worm beds and bedding. And I couldn't believe I was spending money to try to make money. It was a whole concept I didn't know anything about. But, the Buffett's point, this is just a little micro example where you invest money with the objective of growing something, compounding a service, and creating more value on the other side. And that's exactly what happened. I remember spending the $70, but I had enough bedding for a few years, and we were selling like lots of worms. Like we were making in the hundreds of dollars, if you can believe it, in a summer. Like it was just unbelievable that this could happen to me at such a young age. So it's just a neat little micro example of investing into business, compounding service, and compounding value, creating value over time.
Very cool.
And I think it's the first time we've used the word worm in our podcast. Little known fact.
I wonder if that's true.
I don't know.
Yeah, probably.
Probably.
When else would we have talked about that? Okay, so we talked about compounding and discounting, exponential functions that are very important for making financial decisions of all kinds. A lot of these get solved or accounted for by calculators, like with the financial planning software that we use effectively takes all this stuff into account. If you have a financial calculator, you can relatively easily do these calculations, but the point is to be aware of the importance of how the value of money changes over time and how that affects or can affect financial decisions. Now, as importantly as that, so there's the mathematical foundation. These are relationships that are true mathematically. Based on assumptions still, that's a whole other thing. But given an assumption, the mathematics are factual. I don't know, is that the right word? The math is math?
Math is math.
Math is math. So as important as that is, the other thing that's really important to understand, I mentioned earlier that it's not always easy for people to comprehend exponential functions, which compounding and discounting are. There's a couple of biases that are really important when it comes to thinking about this. One is the exponential growth bias. So this is the bias, it's the tendency of people to think about exponential functions as linear, which can cause all sorts of problems. It can explain empirically why people underestimate the interest that they'll ultimately pay on a loan. Mm-hmm. They can underestimate how much an investment will grow over time in the future. Empirically, more biased households, by this bias, this exponential growth bias, more biased households borrow more because they underestimate the cost of borrowing. They save less because they underestimate the long-term growth of an investment. And the empirical result is that more biased households have higher short-term debt-to-income ratios. They have lower stock ownership as a percentage of their portfolios. They have lower savings rates, and they have lower net worths.
Incredible.
Right. So empirically, the bias matters. The other thing that's important here is that people are overconfident in their ability to calculate exponential growth, which further exacerbates the problem. To correct for exponential growth bias, financial planners or people making financial decisions have to use financial math to compare alternatives at a common time period. It's a lot easier to understand the benefits of investing or the costs of borrowing when you're comparing the expected future value of the investment as a dollar amount or the total lifetime cost of the loan as a dollar amount. That idea, I don't know, it didn't originate from him, but Eric Johnson, who's our guest next week, his whole his research is about choice architecture, and he talks about this in his book that it would be a lot easier for people to compare the cost of a loan if you just told them the loan is going to cost you $10,000 instead of telling them what their interest rate is going to be and all this stuff. Real life is more complicated than that because interest rates aren't always constant, and there can be all sorts of different features and things of a loan that make it harder to compare.
Go back to James's example. When you're presented with the cost every 2 weeks of the car,
right,
you can make a long-term, a rash short-term decision that has very serious long-term implications.
Right.
And on top of that, had he gone ahead with that, not being aware of the math of the loan, that's less savings he would have, so he's missing out on the savings plus the compounding on the savings, right? So it's really like two trains going in opposite directions.
Yeah, it's the same train though, right? It's the he's paying that cost and therefore he's losing that cost.
Yeah.
That's why you don't want to finance at 20% because that's 20% that you can't allocate toward other stuff. Now, financial math is an easy area to talk about exponential growth bias, but exponential growth bias does not only apply to financial math. And I think this is a really interesting and important point, especially because on this podcast, we try to talk about how to live a good life, not just how to maximize investment returns. If you think about other areas like exercising, diet, sleep, getting good sleep, they all have compounding effects on health. And I mean, obtaining education is another one. Gaining knowledge, these have exponential effects over time as well on human capital. So it's not just dollars that we can apply exponential thinking to, or that we should apply exponential thinking to, but it's hard. It's hard to think about.
It's so interesting. Those comments relate directly to the book we're going to review, which was unintended, but very interesting.
Cool. Okay, now a related concept that's sort of similar, but it's distinct, and it's equally important to thinking about financial math, is hyperbolic temporal discounting. So that's the tendency of people to overvalue current rewards and undervalue future rewards. People will rationally value rewards in the future less, but empirically, people undervalue them more than they should, basically. So hyperbolic temporal discounting in standard economic theory, we would, what I just said, I guess, we would expect people to have a preference for current consumption over future consumption when the expected rate of return on investments is below the rate of temporal discounting. If they're the same, then people will be indifferent. But hyperbolic discounting makes the time preference discount rate higher than it should be, which leads to procrastination or no saving at all from the perspective of personal finance. Now, the problem, which stems from compounding, is that the costs of prioritizing now at the expense of later increase exponentially over time. If you're not saving any money this year, it won't have much of an effect on your net worth, but compounded over many years, it has a dramatic effect. You don't really notice the incremental effects, but you notice when you don't have any retirement savings when you're 65 years old. That's how those things happen, slowly and then all of a sudden.
Do you ever have an image in your mind of your lifetime earnings? I get this image in my head, almost like a balloon, right? Long clown balloon, where they get kind of bumps in the balloon.
Yeah.
But if you take your life as this long balloon, you really got this big bump in the whatever 20 to 60 year age, right? And really what you're trying to do is kind of flatten that bump out and push some of the air towards the end of your life, right? You're trying to shift consumption forward, take advantage of compounding and saving.
Yeah, that's the permanent income hypothesis, or the life cycle investing. That's like the Modigliani and Merton have done a ton of work on that stuff. But you're exactly right. Those
it's such a simple concept, right? And if you don't try to squish that balloon down as you're going on, there's less air as you get older to push ahead.
Yep. Yeah, the economic prediction is that there's diminishing returns to consumption. The marginal utility of consumption decreases as consumption increases. And so
I use balloons. You use marginal utility.
Well, it all works out to be the same point though. But because of that, people will smooth their consumption over time. So they'll borrow or not save when they're younger, and then they'll dis-save or spend their portfolio down when they're older.
Yeah, in fact, if you're borrowing, you're actually shrinking your balloon out here. You're pushing air back to today because you're bringing your future consumption forward.
Your balloon still stays the same, though. You're just shifting it around a bit.
Correct.
Your lifetime earnings, theoretically, stay
the same. I'm just saying there's not as much air left down the road if you shift forward.
Yeah. You're for sure. You're shifting forward your future consumption. But that would be rational in many cases. Mm-hmm. If someone's constrained and they can't borrow for whatever reason, or they can't borrow enough, then they just wouldn't save.
Yep.
And there are interpretations of this. I've got a future episode on all this stuff. But there's an interpretation of the life cycle model where young people should not save because the utility loss is so great. And that paper actually also argues that automatic enrollment into retirement savings plans is detrimental from a welfare perspective.
Oh man, such a tease.
Anyway, so for the same reason that I just described, alluded to a minute ago, that there's these it happens slowly and then all of a sudden. For the same reason, by the time you find yourself in an undesirable situation, by prioritizing your present self over your future self, it ends up being more challenging to improve the situation because you have less time available to compound. So between the exponential growth bias and hyperbolic temporal discounting, people are really fighting an uphill battle to treat future selves as well as they treat their present selves, which is, I think, for obvious reasons, important when we're talking about spending and saving decisions. There's one paper that I looked at that had modeling estimates showing that eliminating these biases would meaningfully increase retirement savings, which I think just kind of makes sense. Mm-hmm. The cost of spending today in terms of what those dollars could be worth in the future are often far more substantial than people realize. I think that's one of the things we talked to Scott Rickens about. I don't know if you remember that. He's talking about why the 4% rule was so revolutionary for him. And it made him realize if he spends $5 today, what that's actually costing him in terms of future consumption based on the 4% rule, something like that.
Yeah, and also if you spend, let's say you spend whatever, $1,000 a month on a car, $12,000 a year, you need at least whatever, 20 to 25 times that in savings when you're retired just to afford the car.
That's the same math. It's
just math, right?
Yeah.
So if you're spending $10,000 a year on something, you need whatever, $200,000, pick a number, $250,000 of capital to replace that.
Yeah. Yeah. Now the argument's not that all spending is bad. Like I just talked about, in some cases, from a utility perspective, people should not be saving, at least in some theoretical models. Theoretical models.
Decision making, helping make better decisions.
Yeah, exactly. And it also doesn't mean that people shouldn't save when they're young, not necessarily. But that perceived trade-off between spending now and saving for the future, because of the biases that we talked about, systematically favors current spending over saving, and that can cause real problems. And I'll talk about how that maps to regret in a second. Understanding the exponential growth bias can mitigate it to a large extent. So like if you go and do the financial math calculation and you see the ending value or the ultimate result, whatever it is, the future value, the present value, depending on the situation, or the rate of return, whatever the best comparison is, you can make that bias go away by seeing the result. Hyperbolic temporal discounting is trickier because it's not a cognitive bias. Like you can't tell someone, no, that's wrong. No, you're doing the math wrong. Well, no, it's not math. I prefer my future self, my current self over my future self. But this is the Hal Hirschfield stuff, where we start talking about doing stuff like writing a letter to your future self to build that connection, or looking at an aged picture of yourself. Some experiments have found that just thinking about the future can help with that bias.
So you and I just got a copy of Hal's upcoming book, Your Future Self. This is the advanced release copy for review.
Yep, I got it. Got it too.
Hal's going to be joining us in a couple months on the podcast again, a returning guest. Do you ever think about choices you've made or trade-offs with respect to future, like current consumption taken away from future consumption? Have you ever thought about that actively when you make a decision?
Yeah, all the time. It kills me.
Yeah, I remember my first one, like this mall opened up in Sherbrooke, 1973, and I was saving up money from my paper route and my worm business. And I remember going to the Eaton's, and there was this down-filled vest I was dying to get. And I grew up in a pretty modest economic environment, fabulous growing up, but modest economically. So buying anything like that was a big deal. Like growing up, I remember 2 purchases in all the years at home, like big purchases, like a couch and a VCR. Those were like the big events. And I just remember always going, look at this vest. He's like, I don't remember how much it was, but I got so much of savings, but I give up the compounding if I buy this. And finally I did buy it. Like it was one of the few things I did buy, and I loved it, wore it all the time. Thought it was pretty cool at age 7 with this vest. But I think it did lead to early on realizing there's this trade-off that's going on when you do make a choice. And then I remember being at work a couple of years later. I worked in a butcher shop, as many people know. And I remember someone that I worked with being so proud he got approved for a car loan. I can't imagine what the loan rate was back then. And we'd go to the same bank branch, a small Royal Bank branch. He would go see the manager to get his loan approved, and I'd be going to get my deposit slip to put money in. And that's when it hit me. It's like, okay, effectively now, in today's terminology, his cost of capital was my expected return, because I was putting in 9.75% savings bonds. He was borrowing on the other side at whatever rate. But it's incredible how these events just stick out in my mind, almost 50 years later.
That is incredible. It is.
Anyways, keep going.
Okay. So I said that I was going to map this back to regret. And we do have Dan Pink, who's an author who wrote an excellent book on regret, which we've talked about his book because it was part of the Finding and Funding a Good Life paper, and we actually did an episode on regret too. But anyway, this is kind of a quote or a paraphrase from Dan Pink, that regret gives us something like a photographic negative of the good life. So thinking about what people tend to regret can be useful in thinking about what a good life contains. In his book on regret, and also in the upcoming Rash Reminder episode that he's going to be on, he defines regrets related to our failures to be responsible, conscientious, and prudent as foundation regrets. Now, foundation regrets often, but not always, relate back to money. So I mentioned earlier some of the other cases where exponential effects matter that are not money related, but like reading Dan's book, and maybe to qualify Dan's comments a little bit, he did 2 pretty substantial research projects of his own. So in his book, he cites a lot of academic literature, but he also did 2 large-scale research projects, which he was careful to tell us were not really academic research projects. At least one of them wasn't. It was very subjective or qualitative. But he got this massive database of, I think he's up to 18,000 at this point, regrets, like written regrets, where people typed out what they regret. And so he was able to go through this, and then this is where he came up with the idea of foundation regrets by he classified all of the regrets that were submitted into 4 core regrets. That is what he called them. Anyway, so Foundation regrets. The premise of foundation regrets is that our lives require some basic level of stability, but sometimes our individual short-term choices over time end up undermining this long-term need. So that's stuff like not saving enough and then realizing later on that you don't have financial security. So what Dan argues is that everyone requires basic infrastructure in their lives. They require a basic infrastructure of education, financial and physical well-being that reduces psychological uncertainty and frees time and mental energy to pursue opportunity and meaning. Pretty powerful. But due to the effects of hyperbolic discounting and exponential growth bias, we often end up regretting not doing more things like saving, exercise, and learning sooner. So a lot of these regrets map or follow this framework of I wish I had done more of X when I was younger. I wish I had done less of, like one that comes up a lot is drinking. Like I drank too much when I was younger and now I have all these problems.
And the saving one is interesting, right? Because the more or the less you're able to save, the more you really do need to save. Right, because you can't afford to save, you can't afford, therefore, to stop working down the road.
Yep.
Right.
Yep. Yeah, I mean that's an interesting one too, right? Like that paper that I mentioned earlier that argues that in some cases, based on life cycle, in the life cycle hypothesis, some people don't need to save at all. Their reasoning is that through Social Security and like in Canada Pension Plan and old age security, for people with low incomes, the welfare losses from saving are large because their income is low, and the amount that they'll be able to save relative to their government pensions is small. Therefore, they shouldn't save at all. That's their argument in the paper.
I buy that.
Yeah. Anyway, that's a future topic. It's related to this, so I keep coming back to it. But I've got a whole other topic prepared on a lot of that stuff, on like your cost of living, savings rate, budgeting, personal. What did I call it? Personal finance, basic personal finance concepts or something. Anyway, that'll be for a couple weeks from now. Okay, so one of the big problems with foundation regrets is that they're difficult to avoid because of the biases, cognitive errors and biases, but they're even more difficult to undo. If you wait too long to start saving, the biggest asset that you have on your side, which is compounding, is just gone. And like you can't do anything about it. It's just gone. In the short run, people tend to regret their actions more than their inactions. But in the long run, regrets based on inaction, like not saving, tend to dominate. So that's just another interesting point to think about. Okay. So once you understand how financial math works to evaluate the impact of financial decisions over time, and once you understand the biases that can get in the way of that in thinking, at least intuitively, an important question that we alluded to earlier, is it being pretty difficult to answer, is what assumptions you should be using to discount and compound. The assumptions can have a pretty significant impact on financial planning decisions and even asset allocation decisions because of their long-term nature. So like you might have a different asset allocation if you expect an 8% equity risk premium instead of a 2% equity risk premium. A small difference in the discount rate can have huge differences in long-term outcomes. So we, of course, post expected return assumptions that we use for this purpose. FP Canada and the IQPF also post a set of assumption guidelines that are overall fairly similar to ours. In general, stocks are expected to have higher returns than bonds. Bonds are expected to have higher returns than cash. And you'd like to expect that bonds will have higher returns than inflation, but we know from our episode with Scott Cederberg that in more cases than most people would be comfortable with, that doesn't work out. Although there are inflation-protected bonds now, except not in Canada anymore. At least they're going to be they're going to go away. John Cochran wrote a blog article in the Globe and Mail about Canada scrapping real return bonds.
Interesting.
I don't know. Somebody posted it in the Rash Reminder community. So that's expected returns. Step one. Difficult to know which discount rate to use. And then in applying an expected return to a decision, in some cases, not in all cases, but in some cases, you also have to incorporate inflation and taxes. Inflation, of course, is the increase in prices that tends to occur over time. In Canada, the Consumer Price Index, or CPI, represents changes over time in the cost of a fixed basket of goods and services designed to be relevant to Canadian consumers. Even in stable economies like Canada and the US, central bank policies target low but stable inflation. So we expect the basket of goods to rise, the cost of the basket of goods to rise steadily over time. Even at low rates of annual inflation, we got to remember that compounding is an exponential function. If you do nothing with your money, your real rate of return, so your rate of return adjusted for inflation, is going to be negative. If you have $100 in a bank account earning no interest and you leave it there for 20 years, while inflation's 2% a year, your $100 in terms of purchasing power will decrease to about $67. It's a big deal. Clearly an issue for this concept of moving economic value forward through time. Historically, in both Canada and the US, inflation's been about 3% per year on average. So I use 2% in my example. Starting in the 90s, the central banks of some developed countries, including Canada, started implementing inflation targets, which basically just means the central bank will try to keep inflation around their target. And since they started doing that, inflation in Canada has been around 2% per year on average, although 2022 and 23 clearly saw inflation levels that had not been seen since before inflation targeting was put in place. So to take these effects into account, there's I'm not going to talk through the formula because it's got more terms than the last one, and we can post it though in the video if people want to see what it looks like. You can't actually just add or subtract inflation from your nominal return, from your before inflation return. They have to be combined a slightly different way. But it can have big impacts, like calculating the amount needed to retire, for example, using a real expected return. So if you're taking your retirement cash flow needs, your future consumption liabilities, if you will, if you're taking those in nominal terms, meaning that they don't change over time, then you can go ahead and use a nominal discount rate. But of course, most people don't have nominal retirement liabilities. They have real liabilities, or in other words, their nominal consumption will increase over time due to inflation. In that case, you want to use a real discount rate, and that can dramatically affect the amount that you need to save for retirement. So if you calculated your retirement saving need based on a nominal discount rate, you might be in trouble. So that's inflation. Taxes also reduce the return earned on investments. And in some cases, they also decrease your borrowing cost. So in Canada, if you take a loan with the intention of earning investment income, the loan interest can be deducted from your income, which decreases your after-tax borrowing cost. But then likewise, in a taxable investment account, your after-tax rate of return is going to be lower than your pre-tax rate of return, which again, that can change decisions.
So can I give you an example of inflation?
Of course.
It's a vivid example, and one that people may have seen pictures of this online. So back to 1973, a new mall, as I said, opened, and near the mall was our first McDonald's. So we were a family of 5, and we would periodically go to McDonald's before going to the mall. This was a big night out for the family. And I distinctly remember my father saying, we have $5 to spend on dinner for 5 of us, which you can't even imagine going anywhere for $5 now. So I found this old menu, and it is exactly the menu that we would see at McDonald's. I went and did the math. You can actually do it. I remember my father said, but I've got to get the Filet-O-Fish, which was like the most expensive thing on the menu. But we could get, I'm looking here, cheeseburger, 33 cents, hamburger, 28 cents. Shakes were 35 cents back then. So we could do it. 5 of us could go to McDonald's for $5 back in 1973.
Crazy.
I have no idea what it would cost today, but I'm guessing at least 8 times that for a family of 5, I would think.
Did you calculate the Big Mac inflation from then until now?
I did not.
Oh, that would have been interesting.
We had an opportunity. Anyways, we can do the math and come back next time.
I have no idea how much a Big Mac costs today.
I have no idea.
Not a clue.
Anyways, very cool. Very cool math. Anything else to add?
Nope. So that's, again, trying to cover sort of foundational topics on financial planning. And I think that's a big one. And we'll build on that next time, talking about the basic personal finance concepts, which largely feed off of financial math. As we talked about earlier, most financial decisions rely on financial math. So we'll keep building from there, building up the foundation.
All right, well, let's go to another foundational piece, which is about indexing. This one will take me longer than 60 seconds. However, I'll do my best. So this goes back to thinking about the S&P 500 index, which started in 1926, the Dow Industrial Average in 1885. And these were created to sell newspapers, if you can believe it. And in 2012, these two companies merged. And in episode 54, you and I got to go to New York City to sit down with Dr. David Blitzer, who was the chairman of the S&P Dow Jones Index Committee. And we were at the epicenter of the index revolution, sitting, you remember, Ben, right in the actual room where the index composition decisions.
That was nuts.
That was nuts. Like,
I'm going to blow up your 60 seconds, but that was so crazy to be right in that building, right where the indexes are decided upon.
Oh, the building. We were at the table.
Yeah.
Like, for us index nerds, it was pretty cool. Anyway, so that turned out to be an incredible indexing history lesson for us. You know, when Dr. Blitzer started, the idea that you could invest in an index was a completely foreign idea. Then you move ahead to the whole ETF revolution starting in 1993 in the US and a bit earlier in Canada. The whole story is just wild, and he was at the epicenter of it all for so long. So we jumped into details about how the indexing industry actually works. How does the index provider, like S&P, work with a product manufacturer, like Vanguard, for example? How does that work? You know, S&P publishes the indices, and they license the rights to use the index to manufacturers. He described in incredible detail how the committee decides on what is added or removed from an index. And how does it not become an active portfolio? Can indexation become too big? Why passive is such a bad word to describe this? Phenomenal interview. Episode 54. Highly recommended. It's timeless.
Totally.
All right, the book review, which is more like an essay review, but it's really cool. So I went to the office last week to pick up stuff. As people know, I work mainly from home, as you do. And there was a book there, holding it up, How to Live on 24 Hours a Day. And it's from my good friend Blair, who I met in London when I was there. And he thought I'd enjoy it. And it came along with a note from him saying, I thought you would appreciate this book. It's personally had the most profound impact of anything I've read in my life so far. That's pretty powerful.
Yeah.
And if you know Blair, even more so. So this is a 60-page, like I said, it's almost like an essay written in 1908 by the English author Arnold Bennett. And according to Wikipedia, Bennett wrote more than 34 novels, 13 plays, articles for more than 100 newspapers, 24 self-help books, and journaled daily over 1 million words. Incredible. But this book is widely regarded as his most enduring work. So How to Live on 24 Hours a Day is a 12-chapter book, and it's about the treatment of time. We can use time for gaining more money. However, more money can't get you more time. Yes, money might be able to buy you more free time, but we all of us get the same amount of time coming at us. Yes, we have different life expectancies, but the amount of time that you get every day is the same as what I get.
Right.
So to live, what he says, to live is what we're after, and not simply to exist, which is all too often the case. And he says that we can accomplish much more than our day's program, he calls it, our job program. So he said there's many books to show you how to live on X dollars per day, but there's none that show you how to live on 24 hours per day. Out of 24 hours, you need to, and I'm quoting, spin health, pleasure, money, content, respect, and the evolution of your immortal soul. You can waste the current time. However, more time just keeps on arriving. And each of us, regardless of our personal situation, receives the same amount of new time. And he calls hours our little pearls of our life. Interesting, he says people work 8 hours a day, they sleep 8 hours a day. This leaves 8 other hours to live. So he challenged the notion that one is exhausted after work. After all, there is so much time after your work to accomplish so much. So many people do nothing with their time after work, yet complain they are wasting their lives. Therefore, this book offers up advice on how to improve your choices with your time to improve your life. He suggests you should rise 2 hours earlier and maybe retire in the evening a bit earlier. You accomplish as much in 1 hour in the morning as you do in 2 hours in the evening. Do not waste your time that you're commuting. Concentrate. So he gives a whole, it's not long, of course. He talks about how just taking time to concentrate. In the evening, since you're not tired, spend 90 minutes, 3 nights per week on the cultivation of your mind. The other nights you can spend with friends. Spend time reflecting on problems of our happiness, upon our direction, upon what life is giving us. Read more. However, Ben, not fiction, as that is so much pleasure that it sweeps you away. Study something and learn. He's not opposed to fiction, but he's saying don't read fiction to expand your mind. Read it for pleasure. Think about cause and effect. So I just thought it was a really neat book, and I think that's why Blair sent it to me, because we've talked about the power of deep work, of engagement, having purpose, getting into flow, and all these challenges that people have with distraction to be able to do that. So this book is 114 years old and still rings true. So highly recommend it. And it's a good book to consider for your 23 and 23 challenge. And don't forget, on the irrationalminder.ca site, there's a tab there to join the challenge. Still lots of time. And make sure you become friends of Ben and I on Beanstack.
I have not been great about logging my reading in Beanstack.
It's like I've not been great on logging into the community, so
can't do everything.
We cannot.
That book sounds incredible, given that it was when it was written. It's like the I don't know. Sometimes I think about that with and I'm not. I don't want to get into a discussion about religion, but when you look at a lot of practices promoted by religions, a lot of them are related to stuff like what he's talking about. I always found that to be quite interesting, because a lot of religions date back quite far in history, and a lot of the suggestions for how to live your life are based on somewhat similar principles.
Fascinating.
I don't know if that's true for all religions, but for some it is for sure.
To the Aftershow. So we finally finished the series Animal Kingdom. Wow, I didn't realize. I thought we were still waiting for series 6, but it was on iTunes. Unbelievable finale. I mean, this is one of those shows where I was sad that it's over because it was so good to watch. Kind of like Breaking Bad, right? It's like, oh, you'll never see Breaking Bad for the first time again. Well, you'll never see Animal Kingdom.
That show's incredible. My wife and I still talk about, when we're looking for something to watch, we still talk about how nothing's going to be as good as Animal Kingdom.
Oh, that finale was wild.
Yeah.
Wild. Recent reviews. We got one from Dushkick in Sweden. The best investment podcast. Far better than any other podcast with this thematic. Very kind. Speaking of the 23 and 23, a longtime friend and listener, Bruce, reached out to me last week, and he said he's been inspired to read more. And he shattered the 22 and 22 challenge, and he read 40 books. And he is enjoying the Goodreads app, which is the Amazon app that we have talked about. Also heard from Peter from Canada on LinkedIn, who reached out to recommend the book How Brands Grow, based on us talking about that marketing book 2 weeks ago, by Byron Sharp. And he said that Byron Sharp is the Gene Fama of marketing. And I also heard from Timothy from Arlington, Virginia, who thanks us for, quote, the abundance of information each episode provides.
Nice.
Mm-hmm.
in the Rash Reminder community. I mean, lots of good discussion happening over there, but G. Davey wanted to thank the RR team, so I thought that was worth reading out on the podcast. They said, I will make this brief, but it shouldn't go unsaid. Thank you to the whole Rash Reminder team. The podcast, your papers, and this message board have made me a much better financial advisor. Your ability to absorb the literature and organize it in a way that is accessible and useful to me and my clients is unsurpassed. I was already a student of the literature, but you've taken me light years beyond where I was. Thank you for making this happen. Very nice.
There's a lot of advisors that listen, I think.
Yeah.
I know. I hear it from a lot of them. So that's nice.
I'd love to have data on that. I guess we did do a survey. I'd love to have like real comprehensive data though, as opposed to survey data, because we get that question from guests a lot. Like, who's your audience? And we're like, well, we know from like people that tell us that some people who are do-it-yourself investors listen, and some people who are academics listen. Because we've been surprised a few times that someone that comes on as a guest tells us that they listen, or someone that applies for the community uses their university email address. And it's like, whoa, you're in here? But yeah, anyway, I'd love to have actual data on how that breaks down. We mentioned a couple weeks ago that we've enabled a plugin in the community that allows people to subscribe to financially support the community. It's a subscription plugin. We're not selling anything though. It's just like if you want to support the community, you can do that now. There's a button up at the top that just says support the community. We rolled that feature out because the hosting costs, which are based on the number of page views in the community, rise at an exponential rate. The activity in the community it just keeps going up. I'm starting to get, we had to upgrade, I don't know when it was, a while ago, and the price doubled then. And we're getting closer and closer to the next tier, and the price for the next tier says contact us.
Uh-oh.
Which makes me nervous. Anyway, we've had 9 people sign up to support the community, for which we are very grateful. And if people are enjoying the community, then supporting it is great.
Yeah. Meetups coming up. We forgot to mention this 2 weeks ago. Ottawa will be meeting on the evening of March 21st. If you're a listener, you want to come out. We're not sure of the time, but something like, 5 to 9 or 6 to 8. But it'll be the evening of March 21st in Ottawa, then March 28th in Montreal. If you're interested, email info@rationalreminder.ca. Just a casual meetup. Come if you can, as long as you can.
Similar to what we did in London. Have some snacks or something, hang out, talk about...
There'd be some snacks.
Talk about the time value of money. Talk about factor premiums.
Oh, based on the London meetup, it's incredible what you talk about.
Yeah?
Oh, yeah. Yeah, that was so much fun. People we met were great. In the store, for the month of February, we get a bit of a feature, while supplies last. And according to Jackie, there's 40 left. So every order during the month of February until there is supply runs out, every order will get a free toque. So that means you get a free toque, a free pair of socks, and a free koozie. So yes, we're giving away the store. We just want to get the stuff out there. But we have these extra toques, so we want to get them out. It's February. Let's get them out. So place your order before February. And Jackie, you don't have to mention anything. Jackie knows she'll give you a free toque. And also don't forget that if you're an educator or teacher and you'd like to use some Talking Sense cards in your class environment, send us a note again, info@rationalreminder.ca. We'll get you a deck of cards for free. So we had Jacob, who's a math teacher, reached out. We sent a deck out too. And then at Lisa's school here near where we live, she's going to be getting a deck for one of her teachers in the school.
Nice.
Yeah. Went night skiing last night, James and I. Oh, it was perfect. Perfect. -7, lots of snow. A blast.
Yeah, it's awesome. I've only done that once this season. I should try and do it again before things close down. I need to buy equipment, I think, for next year because it's a real hassle to rent.
You can rent in your size for boots?
Surprisingly enough, I assumed no, but my kids were in ski lessons, and when we were in the rental shop, I just asked the guy do you by chance have any boots that would fit me? And he's like, actually, we do have one pair that we keep for large people such as yourself. And I tried them on, they fit. I've skied in them 3 times. And if they're great, like it's fine.
Are you willing to disclose your shoe size?
Oh yeah, I don't mind. It's my shoe size is 17. These boots are 15s, but I think they're like super worn out inside, so it makes them a bit bigger.
Like bowling shoes.
They feel fine though. They're not uncomfortable.
Okay,
yeah,
so
yeah.
Go ahead. No, go ahead.
I think I'll try and buy equipment for next season.
Yeah, rentals get expensive. And it's always a pain
true.
to get it and the time and the hassle.
That's more the deterrent for me is like, yeah, and you have to order it ahead too, so it's like.
Yeah, so we went last night and we had the RFID cards and our jackets are ready for this hill. Just pay online and you just walk in. It's fantastic service. It just works so well.
Yeah, I can do the same thing for the pass, but I have to go into the rental shop to get the.
Yeah.
But the other thing is doing it ahead of time is just tricky because like with young kids and stuff, it's not super predictable when you're going to have time available. Anyway, I did also want to mention that I'm doing a webinar on February 23rd for TD Direct Investing. They do these educational webinars. And the way that they set it up, I didn't ask them why they do it this way. It's kind of an interesting format. We pre-recorded an interview, which I did already earlier this week. So we pre-recorded an interview. It's like a discussion about 5-factor investing and why people would invest that way. And we talked about some of the theory, some of the data, stuff like that. I don't know. It's kind of like a discussion about the 5-factor investing with ETFs paper, basically. But then I watched the webinar watch the interview with all the participants that are there for the event. And then I'm there for a live discussion.
On the 23rd.
So they play a pre-recorded interview with me, which I also watch. And then when that's over, there's a live Q&A discussion. It's an interesting format. But yeah, February 23rd at 1 p.m. There's a link to sign up. We can put the link in the show notes.
Yeah, you can see why. I think it's a great idea. They get good quality content. Don't run the risk of any technology blowing up on them, or if you're sick or
technology,
something.
And I guess there's
compliance.
with compliance too, probably for a place like TD, it would make sense. They've got
in case you go rogue or something.
Yeah, I don't think I would, but you never know. Somebody else might.
So before we hit the record button, you were talking about free throw shots when you're playing basketball.
3-point shots.
3-point shots.
Well, we started talking about this because we were talking about our experience in financial services sales earlier on in our careers, and how there was always this leaderboard, and you had to try and work your way up the leaderboard by getting sales targets, hitting your sales targets or whatever, and you're always competing with the person above you to move up in the chart.
And the people in the top 10 for revenue generation were the top of the leaderboard. They were deemed to be the best people in the company.
Yeah, and you get all sorts of privileges, and you get to go to events and whatever. So we were talking about that, and we were talking about the weird incentives that creates. But then I brought up the basketball thing because those incentives do something, even if it doesn't incentivize the right behavior in the case of financial product sales. So in basketball, there was a similar leaderboard in the locker room, and every day you had to challenge the person above you. And I think you could challenge people more than one spot above you too. So you challenge the person above you at least. And if you beat them, you move up. You take their spot on this board. But the board dictated who. It's similar to the insurance stuff. Like you get all these benefits. Like you're allowed to shoot in games or whatever, or you won't get in trouble for shooting in games. Or you're allowed to take shots in practice that other people aren't allowed to take. Stuff like that. So that competitive that competitive structure did create incentives that in basketball worked really well because that team is known for being exceptionally good at shooting. The people at the top of the board who are allowed to shoot whenever they want, they're the best shooters on the team by definition, like through, I don't know, some sort of market efficiency mechanism. Anyway, but it's applying that to work where you're incentivizing people to do behavior that's we could probably argue not good for them or for the customer, is just a whole different situation.
But I can't imagine how many shots you must have done to stay at the top of that leaderboard.
Yeah, you had to do a lot of shots, for sure. It's part of basketball. You shoot a lot of shots. if you want to shoot, like if you didn't want to be a shooter, you still had to do your one challenge per day. But someone that wanted to move up in the leaderboard would challenge you, because you could challenge more than one person, if I remember correctly, and you can shoot shots outside of that too.
Amazing. Very cool story. You can connect with us as always. We're both on Twitter, although Ben, I know you're not terribly active, but you do follow. You can follow our YouTube channel, of course. Rational Minder is on Instagram and quite active over there. And I love hearing from people on LinkedIn. So feel free to connect and drop me a note.
I don't like any of those places. But you know what we don't maybe say enough is that if people want to chat or discuss topics related to what we talk about in the podcast, the Rational Minder community is a pretty cool spot.
Mm-hmm.
There's a ton of really, really good, high quality discussion in there. It's really well moderated. We have a great team of moderators, a great team of volunteer moderators. We mentioned in the last episode that we were looking for moderators. We've filled, by the time this episode comes out, we will have announced the 2 new moderators. So welcome to them. That's all very exciting. But we have a great team of volunteer moderators who are like hardcore community users who are super into all of these topics. So the moderation is really well executed. And then we also have some PWL administration to make sure that everything stays above board from a compliance perspective. Anyway, it's just a whole different level compared to, I think, what you can find on the open internet. So if people want to have meaningful conversations, it's better than Twitter, in my opinion.
Twitter I like now because I've cleaned up my my followings and followers, following people who I follow. So now they've got the following column set up. So I think that's improved it for me. I love LinkedIn. There's a lot of good commentary going on in there. For people.
There is?
Yeah.
About what?
All kinds of stuff. I just like to see what people comment. There's someone I connected with is hopefully an upcoming guest, made a comment on our podcast today. That's a good example. I think that's interesting. So.
All right. Not a fan.
Yeah. I know you're not. Okay. Anything else this week?
Nope. I'd be interested in feedback from people on the. This is now our third sort of fundamental topic, or we're taking a slightly different direction than what we would normally talk about. I'll give you an example. The topic that I have not prepared because we're doing these more basic ones is on covered call investing. So be interested to hear what people think about financial math in the way that we covered it versus covered call investing with like an equity indexes with covered calls, which we can still cover at some point.
Mm-hmm.
But I'd be interested to know what people think about the opportunity cost of covering financial math instead of covered calls.
Yeah, and we'll see if my quaint stories get roasted or not in the community.
They will get roasted. People will love your stories. I still want to do the covered call one because I think it's a question that's very persistent. I've gotten that question ever since I started doing YouTube videos. Can you do an episode on covered calls? Like, what? A random question. And then people keep asking over time. So, okay, well, I guess I'll do it eventually. And there is some interesting research on it. The other one that I'm going to do for the Common Sense Investing YouTube channel is on international diversification. So we can bring that over to Rational Minder too once it's done. But that'll, I think, fit into our fundamentals theme.
Awesome. All right. As always, everybody, thanks for listening.